Everyone keeps asking me the same question. Is the worst over for housing? The short answer, not yet, according to RBC. RBC's latest forecast points to a slower, choppier path than most people expect, with a few bright spots if you know where to look. I'm Linda, one of the Ragona Sisters, and around here, we keep it real. Please like, share, and subscribe because today we're breaking down Canada's housing market forecast through the lens of RBC. So let's not waste any time and dive straight into the newest RBC forecasts and what it can mean for a seller, buyer, or an investor in this market. Now, let me reset the framework for this properly. The national story is very messy, but it's not a housing crash throughout Canada. It's a slow grind with pockets of strength and a few soft spots you need to see coming. RBC's read is basically this: sales activity takes time to heal. Pricing doesn't just rocket back overnight, and affordability remains tight even if rates drift lower. 3 quick notes to keep in mind as we go through this forecast. Number 1, some properties in the Greater Toronto Area will hold their value better than the headlines suggest, and that includes Vancouver as well. They tend to move even when others sit. Number 2, there are cities throughout Canada that hold up way better than the others because of jobs, migration, and inventory. Number 3, there's a pre-approval trap that quietly shrinks your buying power even when rates drop. Now let's get into the meat and potatoes here. Here's what the forecast implies in practical terms. We're likely in a market where activity firms up gradually, but the price path is very uneven. Some areas level off, others will give back a little, and a handful quietly reaccelerate, believe it or not. RBC's forecast is blunt. 2025 will be another year of weakness. Sales are soft, affordability is still strained, and higher inventory levels in Ontario and BC are creating headwinds. The numbers tell the story. Here is a national prediction. Home sales will be up by 0.7% by the end of 2025, and then they'll come down by 0.7% in 2026. So pretty much you're wiping out your gains. And the further translation is, don't expect fireworks. Prices might wiggle up and then they'll come down, but they're not breaking out. So let's get into it. Why is it like this? Why is it a yo-yo? Interest rates matter very much, but they're not the only variable. Think credit squeeze, think buyer confidence, think supply pipelines and zoning, think population growth normalizing after the surge that we saw in 2020, which was absolutely ridiculous. None of that screams V-shaped recovery. It sounds more like workman-like recovery with risks on the edge. And Ontario and BC, affordability remains very brutal. Inventory is still rising, confidence is still shaky, and RBC says these provinces are most at risk for further softening. Meanwhile, you got the Prairies, you got Quebec, you got Atlantic Canada, and they're telling a very different story. Their affordability is better because their prices didn't go crazy like the other 2 provinces did. Their job markets are stronger, and their housing markets look more resilient. So depending on where you live, this forecast hits very differently. In parts of Ontario, carrying costs of a typical home still eats well over half of a household's income. That's not a typo. For the GTA specifically, the conversation is different from the national averages. This market is more rate sensitive, more price sensitive, and more headline sensitive. We also carry bigger mortgages, higher carrying costs, and higher condo fees than many other regions. So let's break this down region by region. Ontario, RBC calls it one of the weakest spots. Inventories are building, sellers are adjusting, and affordability is still very stretched. Even if prices dip slightly in 2026, the real issue is confidence. Buyers are hesitant to pull the trigger. British Columbia is a very similar story, higher prices, higher inventories. RBC says expect soft conditions to persist. The prairies, very different. Calgary, Edmonton, Saskatoon are benefiting from stronger job markets, better than Ontario, that's for sure. They have more affordable homes and in migration. That's a big thing. RBC highlights these provinces as outperformers. Quebec, more balanced, supply and demand are in better sync, and affordability isn't as strained as Ontario. Atlantic Canada, still attractive. Lower price points, population growth, and demand for retirees and remote workers gives these provinces resilience. So you see, it's not one Canadian housing market, it's a patchwork. So why is 2025 still looking so weak? RBC points to three forces. Higher interest rates. Even if rates ease, ownership costs are still near record highs. Number two is immigration. Targets being cut, fewer newcomers means slower household formation and less demand. And then number three, we have rising inventories, especially in Ontario and BC. There's too many listings and they're chasing too fewer confident buyers. So even with a small price bump in 2025, the fundamentals aren't strong enough to drive a surge. And then in 2026, RBC predicts sales to bounce back, but prices dip again slightly. Why, you ask? Because sales volume and prices don't always move together. More sales might happen, but at a softer price point. Here are the emotional feelings from a buyer right now. Fear of overpaying, relief if they finally find something affordable, or curiosity about whether waiting really pays off. RBC's answer to the last point, waiting doesn't guarantee a cheaper deal. It just gives you more selection, but often at a higher cost of borrowing. So I'm guessing RBC is not betting on larger rate cuts in our near future. So here's the playbook for buyers. They need to focus on preparation, clean finances, and real pre-approvals, and neighborhoods where fundamentals are still strong. You have to buy the right home at the right price with the right terms, and avoid surprises if you can. For investors, your edge isn't timing the macro, it's understanding the micro. True rents, true expenses, realistic vacancies, and whether a neighborhood actually produces sustainable passive income through a full rate cycle. If you're investing in a downturn, you need to underwrite like a lender, not like a dreamer. And for sellers, your advantage is speed to truth. Price for today, not to last spring's price. If your market is giving you a number, meet it or beat it. It's just as simple as it gets. And here are a few takeaways. RBC saying 2025 will end up to be very sluggish. And affordability that stays stretched. 2026 is mixed. Sales pick up, but prices may still soften in Ontario and BC, while Prairies, Quebec, and Atlantic Canada stay steadier. Opportunities are local. Don't follow national headlines. Watch your neighborhood, watch your city, and watch your local market. I know I keep saying this. It's because it's so important in this market. Some may be asking, why is the recovery so choppy? Because rate change flows through like waves. Renewal cycles hit different. For example, some people may face personal mortgage crunch renewals. Others may glide through the renewals because they're on a fixed term, and it's not a single mortgage crisis moment. It's a rolling reality check moment. So layer on top of that construction costs that didn't magically fall, insurance that didn't get cheaper, and property taxes that really go down. And then you add policy uncertainty, things like zoning reforms, development charges. Those can either unlock supply or delay it. And let's not forget about the economic turmoil that affects the confidence of the market right now, like those trade wars. That's a big piece of the pie. You put it all together, and what do you get? A market that resists simple headlines. Now, if you're looking for an inflation hedge in real estate, because that's another question, you focus on cash flow quality. You focus on durability, schools, transit, employment bases, hospitals, the boring stuff. Stuff that keeps tenants and buyers anchored. And on the flip side, where do you stay away from? Segments with lots of investor-owned inventory hitting the market at once. Those, that are infiltrated by investors like small condos, also known as speculators, streets with multiple for sale signs on the same complex street, buildings with rising maintenance fees outpacing rent growth. Here's another thing that I want to talk about. We just went through a quarter basis point rate drop, and a lot of people felt that that was great, that their pre-approval will allow them to afford more. But people don't realize that it's a formula, and the lenders take into account the debt service ratios, and they often get recalculated at current posted rates. So if your income changed, if you added a car loan, if the condo fee that you're looking at is higher than expected, if property taxes in that area are elevated, or if your credit score dipped by a few points, your max number can shrink even as rates drop. So you have to be very mindful that when you are buying a house and you're in that pre-approval stage, that you don't make any big purchases, and that you're in good standing, you're not missing any payments, and you stay consistent with your pay. And if anything, you get a better job, that'd be great, but just be mindful if you're self-employed. So, is Canada's housing market on the mend? Sort of, but it's uneven. And in some places, it may feel like recovery will never come. But anyways, that's going to conclude my video. I don't want to make it too long. And if this video helped, hit subscribe. It helps more than you know. And if you watched right to the end, thank you so much. If you have any questions about the GTA and what your options might be, book a call with us. We'll love to walk you through it. Thank you so much for watching, and we'll see you in the next one.